Alrighty guys, welcome to the Santarelli Exchange. In this video, this class, we're going to go over the three main type of chart patterns to trade. I've been telling members this for a while. If you just look at a chart, it's not going to tell you much. You really have to analyze and draw up the charts so you can see what's going on with that stock and anticipate any type of moves that it may have. So we're going to go over the three main types of chart patterns I like to trade. And if you are patient and disciplined and you're able to wait for these types of setups, you should do fairly well. We're going to go over entry and exits on each of these chart patterns. That way you know where that buy signal is, where that sell signal is, and what you really need to look for. So here's the class. We'll get started right now, and we will do question and answers at the end of the class. Or if you guys have questions during the presentation here, just feel free to hover over that band that goes across your screen for this WebEx seminar, and feel free to ask a question there, and I'll be happy to answer. Alrighty, so to get started, guys, the three main types of chart patterns to trade, there's three. It's a hook pattern, breakout momentum, and range bound, or a stock that's trading within a channel. So first off here, we're going to look at the hook pattern. Okay, let me bring up a picture, larger picture, and we could go over this. Alrighty, so to use this type of chart pattern successfully, we're looking for a few things. First, we need to find a stock that has a large drop, either from earnings, news, or something else that may have caused a sell-off for that stock. It is very important to know that we want to focus on strong companies and stocks for this to work out best, and that we have the highest success rate and highest probability of making a great return. All right, so let me go over to the right here where you see this hook pattern. I'm sorry for how sloppy this is. I just made this up last second here. The other ones aren't this bad, but okay, so as we see the hook pattern, it's basic. We're just looking for that large drop off. I think this is an example here of this one here is Booking, BKNG. So as you see, you had a big drop. This was an earnings drop, and what we're looking for is the previous three candles before the drop. So as you can see here, here's the three previous candles before we had the drop. The stock was trading right around $2,100 a share, and you see here's the red candle right before the drop, and then the two green candles here. And so we're just looking at those past three candles, making sure there's no anomalies or anything like that. So, all right, then Booking had a nice drop after earnings. The stock dropped like a little over 10%. And so it went from $2,100 a share, ended up going down to around $1,810 a share. And so what we want to focus on with the hook pattern specifically is the three candles before the drop, and then after the drop, we're looking for the stock to first settle down. So as you see here, this is the base down here. Right here, this is the shaft that she dropped from. So she went from $2,100 a share all the way down to around $1,800. So that's a 300-point drop in these candles. Each one represent 1 day. So 1, 2, 3, 4, 5. So within 5 days, the stock then got to its base. But like I said here, the shaft, it's important I go over these terms because of how we're going to decide the entry and exits for the trade setup. So the shaft is the drop that the stock had from the three previous candles before the drop all the way down to the base of where the stock settled down at. So as you can see here, Booking had the drop from $2,100 all the way down to around $1,800 a share. It leveled off right around $1,800, $1,810 a share, and then it started to go higher. So what are we looking for with the hook pattern is, like I said, the drop is the first part, and we're going to focus on the shaft and that drop. The second part is the base, and that's where the stock flattens out, and that's where we really want to focus on an entry. Guys, you that are entering, please shut off your microphone. Sorry about that, guys. So, like I said, the shaft, the base, and then the hook. All right. So our entry, we want to get an entry as close to the base as we can to maximize profits and maximize our returns, and so we can capture the full run of the stock after it flattens out at the base. So let me go back over here. All right, so I went over, we see the 3 candles prior to the sell-off, and then once we had the large drop, we're then waiting for the base of the hook to form to tell us that the large selling pressure is over, and then the first candle that gives us a confirmation of a trend higher off the base of this pattern is our buy signal. So as you see here, this is the booking, like I said, after the earnings drop, and right where I marked below the 1810 here, you see the next day we got a clear candle that's above the previous candle. So as you can see here, there's not really a gap, but you could see the 3 candles on this base here that form that base. So here's the base, and then the first candle that we have that's fully above the base and above the previous candle, that's going to be our entry point. So right here, if you could see my mouse going around it on the right-hand side here, the hook pattern, this is going to be our entry for a hook pattern. All right, so that's our entry. Now, when we're making a hook pattern trade, what we want to do before we enter into that trade is decide where our target is and where our stop loss is. And the beautiful thing about a hook pattern is the chart's going to tell us everything. Okay, so first off, you have to see if there's any type of resistance areas from the shaft, the drop, from the base to where the hook started, the shaft up top here. So if there's any type of resistance areas from the base to the top here of the shaft, that's going to be an area of resistance, and that might be an area where we may want to take our profits or have our target estimate for this trade. So as you can see here, this is actually a trade that we made on booking. We did very well. We made around 107% return, and the trade was fairly simple. So what we did, like I said, we entered the day after we got the candlestick above the base. So right here was our entry, and this is the chart that I sent out to TSE members. We had a target of 1930 to 2000 a share. All right, so we got in a little bit below 1850 a share, and our target is 1930 to 2000. So that's anywhere from a 80 to a 150 point move on booking. All right, and we could go over the types of trades you can make on this in another video, or maybe at the end here if you guys have questions about that. But basically what you want to do, the safest trade to make is if you're doing a spread. So right here, if we got in right around 1850, for example, what we could do, we could buy the 1845 strike call, and then we can sell the 1850 strike call. And that way we have a max gain as long as the stock's above 1850 a share. So that's one strategy or technique that you could use, is a vertical call spread, buying an in-the-money spread on a stock like this that's right at the base before it started that move higher. Now, if you're entering into the trade a little bit further up here, then you really don't want to go with a spread. You might want to do a swing trade with some calls, or you could do an in-the-money spread. But you really want to make sure you're capturing this type of move right off the base. So if you're entering down here where we entered, you could either get into an in-the-money, at-the-money, or slight out-of-the-money vertical call spread, or you could buy some regular calls and just hold it for a few days as a swing trade, or however long you're anticipating that move to take. and then you could lock in your gains once it gets to your target area. But going back now, how do we know where the target profit area is and our stop loss area? Okay, so we're looking basically, like I said, from the top of this shaft to the bottom. So if we're looking here, 2100 down to, let's say 1800, that's a, where are we at here? That's around a 250 point move, okay? 300 to 250 point move depending on where we got in. So at 1800, that's a 300 point move. So we're looking at around, like I said, if there's resistance, okay, that's going to be our target area, because obviously the stock's probably going to settle out around there and struggle to break that resistance area. So if there's a resistance area, that's going to be our target. And this yellow line here, this was a resistance area for booking. It traded within this channel for quite some time, which we're going to go over later. But this upper yellow band here, that was the resistance area of the channel we'll go over later. And then the bottom yellow here, this is support. So now that the stock dropped below that, now that bottom one that was support, that's now resistance. So since that's above our target estimate, we really don't have to worry about that. And so our target's going to be halfway from the drop from the top here, these top three candles, down to the base. So like I said, if it got down to 1800, it dropped down to around 1810. So let's just use 1800. Guys, if you're just joining, please put your microphones on mute. All right, so like I said here, so if we had that 300 point drop, went from 2100 down to 1800, that's a 300 point. We're going to look for somewhere in the middle, so around 150. So, you know, if we're looking at 1800 plus 150, that's 1950. That's our midpoint. So if you're making that hook pattern, like I said, where you want to have your target profit area is the middle of that shaft. So if we had that 300 point drop, you're looking for a 150 point move higher from the base of that drop. So from 1800 plus 150, that's 1950. So we put our target between 1930 and 2000. And like I said, we got some regular calls on this. We made a great return. Some of the members got a spread. But like I said, that's what you want to do with a hook pattern. You're looking for that shaft, that drop, the base, and then the hook. And for an entry, you want to go halfway between that drop that it had. So from here, 2100 down to the 1800, that's a 300 point drop that it had. So we're looking for around a halfway return from that drop to the base. So 1800 to 2100, that's 150. Well, that's 300 points, but we're just looking for half of that, so 150. So the 1800 plus 150, that brings us to our 1950 target. And like I said, if this resistance area was down here a little bit more, that would then be our target, as the stock's probably going to struggle a bit at that level. Okay. So let's go back to the Word document here. Now we ask ourselves, what is the target profit area and the stop loss for this chart and trade? And like I said, we went over that. Let me go over the stop area. So if you're in this trade, our stop area is going to be a close below this base. So if you entered into this trade, let's say we entered right here, right where I talked about where we entered at TSE. This was our candlestick. This was our buy entry. Our target was 1930 to 2000. Here was some resistance. Here's the top of the shaft here before the drop. Here's the base at around 1810. So if we entered this trade on this candlestick and then the stock went against us, the first time that the stock closes below this base, so the first time we get a candlestick that closes below 1810, that's our stop loss. And it's a simple stop loss. If you have a stop loss like this, you know, you're going to minimize your loss if the stock does go against you, and really minimize any type of risk of a substantial loss. So like I said, your stop loss area is a close below that base of 1810. The first time you get a candlestick that closes below that, that's your stop. That's when you exit the trade, take a small loss, and move on. But like I said, our goal is to get to our target area, which we did. We made 107% return, and that's how you trade a hook pattern. Okay, so let's see. Our target is generally around halfway from the top of the candle before the drop to the base of the drop. If the stock had a 20-point drop from before the sell-off to the base of the drop, then we're looking for a 10-point move higher from the base. Or if there's resistance area somewhere between the base of the drop up to the middle of the shaft of the drop, that may be our target area, as that is an area of resistance and where we may see some further selling pressure or signs of stock struggling to break that area. As far as our stop goes, our stop is a close below support of the base of this chart pattern. And like I said, I just went over that. So now let's go over a live example that we also traded, which was Facebook. I have these charts here, but I also have them down here to make them a little bit larger. So here is our chart on Facebook, which I also have here on eTrade Pro. So here was a drop from Facebook. Stock had a significant drop. As you guys remember, the stock dropped around 25-26% from all the way up to around $220 a share, and it ended up dropping down to around 166, 165. All right, so as you can see here, this was a perfect example of a hook pattern setup. All right, so first off, let me show you guys this quick, because a lot of people ask me about my charts, and I want to make sure that I'm showing you guys this. So if you're looking at this, here's a chart. Let's bring up Facebook. If you're looking at this chart, this is just a plain basic chart. It doesn't tell you much. If you're looking at this, you might be wondering, wow, how the hell do I decipher this chart? How do I analyze this chart? And, you really have to be a good technician and really plot your charts and analyze them. So as you see here, I always use the 10, 20, 50, 200-day SMAs. I'm always putting up support and resistance areas on my charts. And on this example here, like I said, so here's the hook pattern setup, a live example of Facebook. It had that drop. It bottomed out right around 170 a share. And then that first day, you see a move above, a green move above the previous candle here. This was our entry point. So we got in around 175 at TSE. And then we have a target of 185 here. Now, why do we have a target of 185 here compared to the halfway of that drop? You guys seen, I just went over that. We have some resistance area right around 185 that I felt the stock was going to struggle with. And so we had a target of 185 a share, and then we just took our profits once it hit right around that target of 185. So we entered around 175, and our target was 185. In this example here, you could do a spread, an in-the-money spread, out-of-the-money spread, slight out of the money. Obviously, if you're making a spread, you want to make sure that if you have a set target area, you want to use your delta thetas and analyze that trade. Make sure that that trade's going to make you a decent-sized return compared to the risk you're taking. And like I said, so our target was 185 a share. That's because we had resistance up here, pretty strong resistance area, and I felt that would be a good target area. And I even further went on and told members that if you want, we could take half of our profits at that 185. If we see it struggling there, we could take the rest off the table, lock it in, be out of it. Or if it just continues to jump higher once it hits that resistance at 185, then you can hold on to it and, hold on to your other half and let that half run. So at least take that half off the table there once it reaches your target, if you have a resistance area right around there. That way, if it does struggle, you're already out half of the trade already. You took your profits, and if you see it struggling, you could take off your other half of the profits And if it doesn't struggle and continues higher, then the other half of your trade can go on to continue to make some profits. All right, so where was the exit on this trade? You know what? Let's do a little bit of interaction here. Can anyone tell me where would the stop loss be on this chart if we entered the stock right around 175? Let's say we got a spread of 172.50, 175 vertical call spread for the next month's expo. Where's our stop loss going to be on this trade? Can anyone tell me? Please type in the chat if you guys know. Dr. Phil said 169. Close, Doc. Yeah, that's right about right. So I said a close below the base. Our base is 170 here. So any move below 170, if we get a close below 170, that's our stop loss area. So that's a great job, Doc. That's right. So we're looking, like I said, if the stock closes below that 170, that's our stop loss area, and then we have our target of 185. So when you're entering into a trade, it's important to have all these things set up, ready to go. Know your entry, know your stop, know your target profit area, and you'll be good to go. Let's get back to the Word doc here. All right, so we went over the hook pattern, and we went over the Facebook example. Here's another one on Oracle. Little example here. All right, so this is a little bit smaller of a drop, but it was another one that I mentioned in the room back in June when it happened. I save all my charts that I share in the trade room. That way we could go back, teach from them, analyze from them, and discuss them at a later date. So right here, Oracle had a drop from around $46 a share that you see right here, and it dropped all the way down to around $42.50. Okay, so the stock had between an 8 and 10% drop. So between a 7 to 10% drop we had on Oracle, and like I said, we had the base then. This is a smaller example because I want to go over a few different types. That way you're not just looking for that textbook chart pattern that you're not always going to see. So here's an example of a smaller type of hook pattern we can take advantage of. And this one was simple. We had the base here. The next day, we had a green candle. Didn't move too much though, but the next day we had a nice move, and this would have been our entry. We probably wouldn't have entered here. We would have entered on the third day after the drop, and then our target is between halfway from the drop to the base. So we're looking right around here as a target. So if you entered on the third day after the drop here, you're waiting 1, 2, 3, 4, 5, 6, 7, 8 or 9 days was the duration of this trade if you entered this smaller hook pattern here. But same concept, like I said, your target's going to be halfway from the top of the previous 3 candles here. So here was the top of the previous 3 candles before the drop. Like I said, that was a little bit above $46 a share, maybe $47 a share, and then it dropped down to that $42, $42.50. So we had about a 4-point drop. So you're looking for it to climb by around 2 points. So around 44.50 to 45, that's your target, and then obviously our stop loss is a close below 42.50. So that's how you do that. This is a smaller type of an example here on Oracle, but same concept. You're looking for that midway point between before the drop to the base of the drop. Halfway between that, that's your target, and then our stop loss is below the base, which is 42.50. First day you get a close below 42.50, you're out. First day you reach that $46, $45 area, that's your target profit area. You could either take half off the table, you could take the entire trade off the table, lock in profits, or do as you please. Because as you see here, it had a significant run after that. So if you're just locking in gains right around here, you missed a lot. But That's how you want to set up your trades for hook patterns, because they're not always going to go off and run like that and make new highs prior to the sell-off. So it had the sell-off, and usually it doesn't reach back up to that level it was at before the sell-off this quickly. I'm not sure what the circumstances were here that it did run higher than it was before the sell-off, but sometimes it happens. And like I said, if you're exiting here, you're still leaving some on the table, but this is going to help you in the long run because they're not all always going to run like that. So like I said, the target halfway between the drop and the base, and then the stop loss is a close below the base of 42.50. Dr. Phil asked, what would you have done with the trade at the March 14 drop? Let me go back to it quick. The March 14th. Okay, so you're talking about this drop right here. Well, Doc, if you're looking at this, you're looking for a base. You have that base right around here, but it really didn't do much. Like I said, the whole point of a hook pattern too is not just a large drop. You don't want to just find a stock that has a large drop. You want to find a stock that's forming a hook pattern. If it just has a drop and then it's flat, that's not a hook, that's an L. So we're looking for that hook pattern. So as long as it came down and it's flat, that's not an entry, that's not a hook pattern. We're looking for that sign where it had the drop, and then within a few days, like within 4 or 5 days, if it doesn't start to have that hook, then it's just a flat stock, and it probably wasn't going to do much. So we're looking for a stock like here, you're talking about the March 14th. If it dropped here, and then let's say after this long red candle here, let's say the next day we had a green candle that went up to this yellow line here, which is a 10-day SMA, that would have formed a hook that we would have been interested in entering. But since we had that sell-off and you see the slant here that just kind of kept going lower, that's not an entry. Like I said, you're looking after the drop. If there's, if it's just 4 or 5 candles and it's not doing much, then that's not a hook. And we're looking for within 5 candles for it to start to hook up and start to form that hook pattern. So if it doesn't form that hook and it's just an L shape like this one is, you pass on it. That's not a hook pattern. All right, so second type. So the first one was the hook pattern. The second one is breakout and momentum patterns. All right, this was TSE's #1 pattern that we traded for the past several years as we were in a big bull market, and we just kept climbing higher and higher. And the breakout momentum patterns are really what made us the largest profits, and that's most of the types of trades we traded for the past several years. Market has changed since around February or March of this year, so now we're looking for more of the hook patterns and channel range-bound trades. But the breakout momentum patterns, those are the patterns that you really want to trade on a strong bull market. Obviously, you're going to get more of the hook patterns on a flatter market or a bearish market, and so you go from there. So breakout momentum patterns. We are looking for a breakout momentum pattern to trade. We are obviously looking for a stock that has momentum and is steadily climbing. To find these types of chart patterns, we are going to use our SMAs, which are our simple moving averages, to help us find potential stocks fitting this pattern along with entry and exit areas. It is also important to know that we also want to see the general markets participating in this general trend. For example, if we find a tech stock that fits our criteria for a breakout momentum pattern, we also want to see the NASDAQ or QQQ ETF showing signs of a move higher as well. This type of pattern, we are going to use the 10, 20, 50, and 200-day SMA as our guide. We are looking for the stock to be clearly trading above these SMAs for our entry, and then we can use the 10, 20, 50, or 200-day SMA as our exit, depending on our time frame of our trade. If we have a shorter term trade, we will focus on the 10 and 20-day SMA for trades less than 1 month till expiration. And for trades longer than 30 days till expiration, we're going to use the 20, 50, and possibly the 100 or 200-day SMA. I'll go over an example of how we do this below. So below here, this is a chart of Amazon. Let's get that one up here. All right, so here's a chart on Amazon. This is a breakout chart example. And what we're doing with a breakout or momentum type of chart pattern, we're looking for the stock to be clearly trading above the SMAs. Okay, so let me get a live chart up here so we could go over that. All right, so if you're looking at this chart here, here's Amazon. This is a beautiful trend higher. This is considered a breakout momentum trade. It's still within that range. So like I said, let me go back a little bit more here so I can show you what to stay away from. All right, so when a stock's trading between these SMAs, and this is important, guys, really take a look at this and see what's going on here. So as you see, here's Amazon from February of 2017 up till October of 2017. So from February to October of 2017, as you see here, Amazon didn't do much. You did have a breakout momentum from right here, from March 29th all the way until, June 9th. But besides that, see how the stock is trading between the SMAs here. You really don't have any clear entry or exits. You're not having a breakout. The stock's pretty flat. And like I said, this is an area that you want to stay away from. You're looking for that first sign that the stock clearly closes above the, here we have the 20 and the 50-day SMA. I took off the 10-day SMA because it's gonna be a little bit more complicated for those that are new to trading to see what I'm talking about. So we'll take that off for now. So you could see here using the 20 and 50-day SMA, the first time you get a close above that SMA, that's your entry point. So as you can see, let's say right here if we entered, and this is a good example here, but you're going to see why it's not a good setup right here. So as you can see, you're waiting for a clear move above the SMAs, and if we enter, let's use the 10-day just as an example here. Let's make this yellow. So here we go. So we're looking for the first time the stock closes above all three of those SMAs. So we could either got an entry signal right here on 7/10 of 2017 or the 2 days later. So let's say we entered here on 7/10. We got in, let's say, for around 886 a share. Or I'm sorry, 986 a share. So if we got in at this candle right here, the first day it broke above these SMAs after trading within them for a while. If we entered here at, what did I say? Let's just use 1990 as the example. Our first target, like I said, is a close below the 10-day or 20-day, whichever one comes up first. Obviously, it's going to be the 10-day since that's the closest lagging indicator that we have. So if we entered at 990, our sell signal is the first time the stock, the candle is below that 10-day SMA. So if we entered at 990 over here, and then here we got our exit, obviously it had an overnight drop. Our exit's at around 1030. So you made 130 point profit if you bought the shares or if you got a call or a spread. But like I said, this is kind of like a false, it's not a false signal, but it's not a run like you're really looking for. And I'm going to go over that run that we're looking for right now. So here's the type of run that we're looking for. And the reason why I took the 10-day SMA out of this is, like I said, let me I'll get rid of these. All right, so let's get rid of the 10-day. All right, so like I said, your first buy signal is a move above the SMA. So if we got in, let's look at right here. This is a nice move higher. These are the types of moves that we're looking for, where you're seeing the stock clearly above these SMAs. And this is what's great about charting and technical analysis. If you guys can find a way, like I have, that I'm going over with you guys now, if you could find a way to enter a stock that could capture these types of runs that you're seeing right here, here, and here, you're going to make large profits. The thing is, you have to be disciplined and you have to be patient and you have to know exactly what to look for. So like I said, we're looking for a move above these SMAs. Okay, the first time the stock clearly closes above, let's say we entered right here. We had a big move higher the next day. Here's the green candle. This is on 4/27. So April 27th, the stock's right around, let's say, 1,600 a share. Was down to 1,576. So let's say 15. Let's just use 1,600 as an example here. So if we got in at 1,600, right in the middle of this candle right here on the 27th, okay, so what are we looking for once we enter into a trade that's clearly above the SMAs? What we're looking for is the first time the stock closes below the SMA. So as we're seeing here, the 20-day SMA, the first time we get a close below that, that's our exit point. So if we entered here around 1,600, we didn't get an exit signal until right here on 6/25. So it was nearly 2 months later that we were in this trade that we got our exit signal. And this is at $1,700 a share. So if we got in here right around 1,600, we probably would have gotten in earlier. We would have got in at the open at around 1,570. But let's just say we got in at 1,600. That way, that gave enough time for everyone to get in and get the alert. So we got in at 1,600. Our sell signals, the first time we closed below that 20-day SMA, we got that here at $1,700 a share. So we made a 100-point move in about 2 months. That's pretty good, especially if you're doing an in-the-money spread and at-the-money spread, or if you're getting some calls for a few months out. That's a pretty decent return. All right, so now let's see what happens if we entered the next time then. So we exited here, all right, and then we got our next buy signal of a breakout right here at around $17.30 a share, right on 7/9 of 2018. So June 9th, we got our entry signal at 17:30, and then we didn't get our sell signal until right around $1,800 a share, as you see on this red candle on 7/30. So June 30th, so from June 9th till June 30th, and also what I want to go over here quickly is a lot of people ask me, Dave, how do you determine what expiration date to get or what strike to get? First off, when you're buying options, you do not want to buy, deep out of the money strikes or, far out of the money strikes, because you need a significant move for the stock to get to that strike. And it's just not a good business model for trading. So when you're trading breakouts, momentum, you're looking for either an in the money, at the money, or a slight out of the money. So if we entered into this trade, like I said, when the stock was around 1725, we're looking at anything from the 1725 up to maybe the 1735 strike. I really don't want to go too much higher than that because, like I said, then Thetas is going to kill you, and if the stock doesn't move, that option's going to decrease in premium quite quickly if the stock moves against you. So you want to have a strike that's close to where the stock's currently trading at. So like I said here, if we got in at 1725, we're looking from anywhere from the 1700 up to the 1735 strike. It's okay to go deeper in the money for your strike, but it's not good to go further out of the money for your strike. And like I said, also, The big thing I wanted to go over here is people ask me about the expiration date. Well, look at the stock, and it's going to be different, obviously, for each stock, each company, but kind of get a gauge of what the stock has been doing. So if you're entering here at that 1725 area, if you're getting the 1725 strike call for, let's say it's $50 for 2 months out till Expo. Okay, so you need it at 1775 to break even, and then 1825 for 100% return. So if you're getting in right at 1725 and you say, okay, I'm buying this option for 2 months until Expo for $50 a contract, you really want to look then at the previous 2 months and determine what type of move it had. So if we got in there at 1725, like I said, that's on 7-9. So let's see what it did from 5-9 till 7-9. So if we go to 5-9, here's 5-9 right here. So from 5-9, it was at 16, let's say 1600 to 7-9, it's at 1725. So it had around a 125-point move in 2 months. So if you're looking at that and say, okay, from the previous 2 months, it moved up around 125 points. What's the stock going to do from 7-9 until further? Like I said, if you're not seeing this and you're just at 7-9 here, which is right here, if you only have this up, like if today was June 9th, and you're saying, okay, where's the stock going to go from here? I just got the breakout signal. I just got the buy signal at 1725. What am I going to do? So like I said, if you bought the 1725 strike for $50 a contract, obviously you needed at 1775 to break even, 1825 for 100% return. So like I said, look at the previous 2 months when determining what strike, what expiration, see how the stock has moved for that time frame that you're looking at. It could be any time frame. If you're buying just right now and you get the December monthly expo, right now it's September, then that's 3 months until December, then look and see what the stock has done for the previous 3 months. It's that simple. Just see what the stock has done for the previous time frame that you're looking to trade for right now. So if you right now you're making a trade for 6 months out, look and see what the stock has done for the previous 6 months. All right. So like I said, that's the breakout momentum trade. This is just the stock on Amazon, the chart. Like I said, your entry is the first day it's trading above the SMAs, and then your stop to take your profits are when the stock closes below that SMA. It doesn't necessarily have to close below. Let's say right here the stock dropped down to that 20-day, but then went higher. As long as it didn't close below, that's okay. That means that SMA in this example right here, the 20-day SMA, that's kind of acting as a support area that the chart is the stock's bouncing off of. So that's a great sign that further tells us that the stock still has momentum and still probably going to run further. So that's what we're looking for, is a close above the SMAs for our entry, and then we take our profits once the stock closes below it. Alrighty, so we have another chart here. Let's go over this one. This is another example of a breakout trade. So here's Nike. All right, Nike has been great. We could actually bring that up on E-Trade here. Let's take a look at Nike. So here's the stock on Nike. And I want you guys to see this as clearly as I do. Do you guys see this over here? Over to the left here, this is the type of run that we're looking for, that we're moving from $50 a share all the way up to, $65 a share. That's a 15-point move on a $50 stock. That's a significant move. That's what? That's over a 20% move higher from 50 all the way up to 65. So those are the types of moves you're looking for. And let me just do this quick. So here is the type of moves that we're looking for. This is a momentum breakout chart right here. And then let me get the other marker here. And then you see once the stock starts trading between these SMAs, this is an area that you want to stay away from. Okay? It's that simple. I'm telling you guys, if you have the patience to wait for these setups, you're going to do extremely well. And you get so many signs as well that's telling you it's a good breakout. You see the nice move here on the MACD, and then once we get here, you see we stay pretty flat. And then once we start to climb again, you see we have another nice setup right here. So we had another nice breakout right here. Here's your entry right here. And then you're closing the first day. You get a move below that SMA. So here is your exit. So you're making a significant move from around $67 a share all the way up to about $74 a share. So you made a significant move. And like I said, each of these are one single day. So we have 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15, 16, 17, 18, 19, 20, 21, 22, 5, 6, 7, 28. So you have 28 days between this move. So this is 28 days right here. So that's a 28-day move. That's why I say when you're trading, guys, there's so many traders that are going with weekly expos. And I'm going to be the first one to say I love trading weekly expos. They worked extremely well for us for the past several years. But you have to understand, we're in a different type of market now. We're not in a huge breakout mode that the market's rallying, making new highs every single day like we've seen for the past several years. Right now, we're kind of, we did recently hit new highs again, but the market's not like it was the previous several years. So, previous years, you were able to get weekly expos because the stock just kept climbing and climbing, and you're able to make substantial returns with just trading the weekly expos. But now that the market has changed, the market conditions, you really need to go with a little bit further out of an expiration day. As you see, it's taking a little bit longer for these stocks to make these significant moves now. So, a 1 or 2 month expo for regular calls is fine. Or if you want to do weekly expos, that's when you want to start looking at in-the-money spreads or an at-the-money spread, something that you don't need a significant move for to make that max gain or a substantial profit. So like I said, if you're going with something, that's a month further out, like I said, look at what the stock's done previously. Obviously, when you're in breakout mode here, it really doesn't matter. You have your set entry and exit points. Here's your entry. Your exit's the first day. It closes below that 20-day SMA, and you're making substantial returns. Another day here, you got in, here, obviously, you see a big breakout. If you did enter here, and, it's not going to work every single time, just like anything else. You see if you entered here, you got your sell signal on this day, and you're taking a small loss. That's the one nice thing about trading breakout momentum types of patterns is you're really not going to have a huge loss because you're trading so close to that SMA and you have a set target area and a set stop loss area. So like I said, if you're entering the trade, let's say we entered right here when we got into the trade on this side, over to the left here where you see this blue here. If you entered right here for a breakout trade and the stock immediately went against you and it hit that either red 50-day or blue 20-day SMA, you're only taking a small loss if the stock is hitting right here because you're not having a large move and your stop area or your target profit area. It's so close to that SMA. That's the beauty of trading breakout momentum, is that you're really not taking on a large risk unless you're doing weeklies, and if there's some type of news or something in the markets that's going to make that stock immediately drop significantly the next trading day, you're really not looking at too large or risky of trades compared to the other ones with trading breakout momentum stocks. So that's what we're looking for with breakout momentum, is the first sign or the first close above the SMA. So like I said, if we exited here on this trade, this was a losing trade. That was no good. Our next trade, here was our entry, and then we got our sell signal right here. So from around $76, $77 a share, all the way up to around $81 a share in a short period of time. 1, 2, 3, 4. So around a 2-week time frame, 3-week time frame, and you got your sell signal, you took your profit, and you moved on. So that's the second type of pattern that we're looking for. So we went over hook patterns, breakout momentum. Now the third one is range bound or channel bound patterns. And you guys are going to love this because it cannot get any simpler than this. It can't get simpler than this, okay? So in this type of chart pattern, we're simply looking for a stock that is trading within a range for some time, that has clear levels of support and resistance, clear entry and exit areas we can use for trades. And this type of pattern generally takes on trades that need the most time to get to our target areas and requires the most patience and discipline. We are looking for entry and exit areas based on these ranges and channels, support and resistance areas. Our target profit areas are the upper area of these ranges and channels, and we have a strict stop loss area if the stock breaks below that range or below that channel, as I'm going to go over right now. So this is a great setup here that I have. Let's take a look here. So this is a range bound, channel bound type of pattern that we're looking at here. So as you can see, this is Disney. So this is Disney. All right, let's take a look. As we see, we drew up a nice chart here. We drew a channel that's going back from April, actually back from March until it's still in it right now. So March until now, that's what, March? So 6 months it's been trading perfectly within this channel. And now take a look, guys, because we're on this right now. This is actually a stock that you could trade tomorrow morning, all right? This is such a great setup here that I'm probably going to go and make a trade on this as well. All right, so like I said, this is our third type of chart pattern, range bound or channel bound type of pattern. And what we're looking for here is a stock that's clearly trading within a channel or within a range. This one's a channel right here on Disney. And as you can see, every time it's getting down to this lower channel, this lower band here, which this is our support area, every time it drops down to this area, it bounces up and gets to that upper band. And it's just like a rubber band. It gets down to this channel and it strikes back and goes higher. And then once it hits that band, it collapses, goes to the next band, and it keeps playing that back and forth type of motion and going higher. All right, so as you can see here, this upper band of the channel is our resistance area. As the stock gets to this level, we start to see selling pressure and the stock generally pulls back. And then right here, the lower band of this channel is acting as support. And we are seeing the stock bounce higher once it drops to this level. This is an area of entry. Okay, this is a great entry area. So anytime, like right now Disney's at this lower band, this is a great entry for Disney, and then you're looking to sell it. Well, let's go over this first before I jump the gun here. So like I said, just on hook pattern setups, you're looking for any areas of resistance that may, that may interfere with that trade or may interfere with that channel. And this is a perfect example. It couldn't get any better on this example. As you see right here, we have resistance. whoever just joined, please put your microphone on mute. All right, so as you can see here, resistance number 1, let's pull up the chart on Disney on E-Trade Pro actually. So as you can see here, let me make this smaller. There we go. So as you can see here, Disney right now is at 110.75. It has resistance around 112.50. So around 112.50, it has resistance going all the way back to 2007, over a year ago, back in June of 2017, May of 2017. Okay, so this is resistance. So if you're entering into this trade right now, first off, like I said, you're drawing this chart up. You're going to put on your support resistance areas. And like I said, so here's resistance 1 at 112.50. Resistance number 2 is at 116.50. Okay, so if you enter into this trade tomorrow, which I'm personally going to enter into this trade, you're looking first off, you know in your head, just like right here, and like I said, this was a perfect example. The stock got up to that, it got right up to that resistance area. Actually, it dropped back down from being at resistance number 2. It dropped back down to, which was then support at this resistance 1. Guys, whoever just joined, please put your microphone on if I can hear you, and it's interrupting. All right, I think I muted them. So like I said, it got up to that resistance 2 area and even broke above that. And then when it came back down, this, which was resistance, is now support. It kind of held that support area before finally dropping. And then the outer band or the lower band of this channel acted as support, and it's now going to bounce higher. So right now what we're going to look at, we're going to see if Disney is going to get back up to that 112.50 area. If it struggles at that area, then that's sign of weakness, and possibly take our profits and move on. But if you see it struggling and then breaking through, that's sign of strength and sign that she's going to go back up to that next resistance number 2 area at 116.50, and then possibly even hit this upper band. So what are we looking for with this trade? Well, let's take a look. So if we enter into this trade, what do we want to happen? Well, if we enter right here where the stock's currently at, that's our entry at 110.75. Okay, and then what we're expecting the stock to do is go up to this area here, which is our resistance 1. So we have resistance at 112.50. So if we enter this trade now, we already know we're getting around a 2-point move higher, which is going to be a nice profit for us. So one of two things. We enter this trade now at 110.75. It's going to get up to that 112.50 resistance area, and it's either going to struggle and then pull back down to right here, and then it might, go higher from there. Or what it may do is get to that area and then just climb higher and higher. Get the pen here. All right, so like I said, guys, if we're entering now at 110.75, we're going to have some type of resistance around 112.50. If it breaks through that, we're looking at that next resistance area of, like I said, 116.50 or this upper band here. This is important. These bands are extremely important. These are the channel bands. So we want the stock to make sure that it stops here. It doesn't get below, and this is our target. Okay, now obviously if we're entering into the Disney trade right now, we're looking for anywhere between 115 and 117 as our target to take profits. But like I said, this is very simple and easy to trade, a channel bound type of trade. All you're looking for is entries that are right around the bottom of this channel here, which is support. We're entering at these support areas, and then we're looking to sell once we get up closer to that upper band, which is then resistance. So it's really great. Over here, I said, notice how the stock struggles each time it gets to an area of resistance, and then either breaks through for another run higher or fails to break above, and then you see the stock pull back before retesting that area once again. So like I said, this area right here, this is an important area. If you enter into Disney and it struggles, like I said, if it gets up to that 112.50, you see it struggle, and then the next day it has a red candle and starts to come back down, that's when you want to exit the trade, take your profits. It might be a small profit, a decent profit, depending on what strike and expo you get, but you're still going to have a profit from 110.75 entry up to that 112.50 first resistance area. So like I said, if it gets up to that 112.50, you see it struggle, and then the next day you have a red candle and it starts to go a little bit lower, that's your time to exit the trade, that it might go back down to the support again. You want to lock in your profits and wait for the next entry signal. Or like I said, option number 2 is it gets up to that resistance 1 area of 112.50 and it breaks through it, and then it's going to head up to that resistance 2 area, which is at that 116.50, or up to this channel right here, the upper band here. So that's your other target area. Whoever just joined, please mute yourself. This is a pain in the ass, this thing here. I got to find out how to mute people once they enter into the meeting. Either way, guys, like I said, this is a very simple, easy to use, easy entry, easy targets, easy stops. Like I said, I didn't go over the stop yet. So if you enter into this trade tomorrow at 110.75, your stop is the first day the stock closes below this channel. Okay? So the first day you get a close below this channel, that means this trend is over, the channel's done, and you exit the trade. Take a small loss. Obviously, if you're trading right at this channel here, which is where you want your entries to be, obviously, if it just goes down a little bit more and crosses below this channel, you're not taking a significant loss. It's a small loss. You exit, you move on. So that's the thing, guys. With these 3 types of patterns that I went over, it's simple enough that you have your clear entry and exits. If you have the patience and discipline to follow just these 3 types of patterns, you're going to do extremely well, and you can make huge gains, huge profits, huge returns if you just have the patience and discipline to follow these 3 types of trade setups or chart patterns. And like I said, the nice thing about these 3 types of chart patterns is the entry point on each of these patterns is so close to your stop area that if the trade should go against you, you're not going to take any significant type of loss, unless obviously the market tanks overnight or has a huge drop or correction overnight that you can't control. But if it just has a move lower the next day and it's below that stop area, you're out of that trade with 10% or less loss, and you can move on and wait for the next one. And like I said, if your max loss is, let's say we enter into one of these 3 types of chart patterns. Let's say our max loss is 25%. It should not be any more than 25% on these 3 types of chart patterns. But if you do enter into the trade, and let's say it loses 25%, you exit the trade, you already know your max loss on any of these types of trades that I just went over, these 3 types of trades, is 25% max stop loss. So you're only risking 25% to make, like this one here on Disney. If this goes from 110.75 all the way up to this 117 area to the next band, you're looking, if you have regular calls on a solid blue chip stock like Disney, you could be looking anywhere from a 200 to 400% return. If you have a in the money spread, you could be looking between a 60 and 90% return. If you have an at the money spread, you could be looking anywhere between a 90 to 110% return. And if you do a slight out of the money spread, for example, Disney right now is at 110.75. Let's say you got the 112, 113 spread for, let's say you got the 114, 115 vertical spread for next month's monthly expo. You could be looking anywhere from a 200 to 300% return with an out of the money spread like that. And the nice thing with these channels or any of these types of trades, you don't want to go with a trade that's out of this channel. For example, there is no reason to get a 120 strike call or a 118, 119 spread, for the next 30 days out, unless it's much further out until Expo, if it's 2, 3, 4 months out. But, you want to get trades that are within this channel. You don't want to be hoping and making lotto ticket trades that are, 120 strike that's well out of this channel and beyond reach of Disney. So, like I said, it just got up to 118 recently in the past, 2 or 3 weeks. So, that could be our target for the next 30 days out. So let's say we got a October 19th monthly expo. We could go as far up to 118 as our strike. Nothing above that. Obviously, that's the outer limit. That's the riskiest trade you can make, but also has the largest potential reward as you're much further out than where the stock's at right now. But on a trade like this, what I'd be looking at is either buying the 110, 111 strike call, or I might do the 110, 111 vertical call spread for, anywhere between next week's weekly expo or further out, up to 30 days. So that's what you want to focus on for that type of setup for a range-bound or channel-bound trade. So that was Disney. Now let's go over another example here on booking. So we went over a booking trade, the hook pattern right here. If you guys remember, that was our first chart that we went over. Let's take a look at that one more time. So here was the pattern that I showed a hook pattern on and how it works. This was with booking, and that was a perfect example of a hook pattern. Now let's take a look, and first off, now you could see this was our trade that we made right here, and the stock ended up getting to our target and even much higher than that. It was a perfect type of trade setup, trading that hook pattern. All right, now if we go back a bit, you could see here what I was talking about earlier on in the video. This is a range-bound channel. Okay, you see it just keeps going up to resistance, falling back down to support, up to resistance, back down to support, resistance, support, and it kept doing that for several months. It did that from February of 2018 all the way up until mid-August of 2018. So for 6 months, it traded within this range, and that's why this is called a range-bound trade, because every time it got up to this resistance, it pulled back. And what you want to do, people I know will ask me, how do you know it's in a range-bound? Well, you want to look for 2 points, okay? So when it dropped, first off, you have 1 point right here. Here's another point. You want 2 points for support, 2 points for resistance. So you have 1 point here that contacted for support. Here's one for resistance. Here's another one for support. And then here's the other one for resistance. And then here's another one for resistance. Here's another one for support. But like I said, guys, you're looking for 2 points of contact. So once you get up to this area here of resistance, you could have said, hey, I'm going to buy some puts, or I'm going to buy a put spread and capture that return as the stock drops back down to support. And then once it gets down to support, you could clearly do a reversal and buy some calls or a call spread and trade that back up to resistance area. And then once you see that signal, Once you see a candle that drops below the previous day's candle at that resistance area, you could then reverse and buy the puts or put spread again, and you could just keep following that until it breaks that channel or range. All right, so you see this was a range bound type of pattern. Then it had earnings, it dropped, and we were quickly able to pick that up as a hook pattern, trade it to that 1930-2000 target, and we profited. We profited so much on booking. It was unbelievable. We had some really significant gains of one of them made over 176% return. This most recent one just made around 107% return back in mid-August. So that's what we're looking for. And as you can see, guys, always use your tools and indicators. Down here, you see the RSI went below 30. That's obviously a great sign to pick up some shares, pick up some calls, a spread, whatever it is you want to do. It's oversold at this point and usually typically tends to go higher. So that was a great point. And then once you've seen the crossover on the MACD here where the white line crossed above the red, that's another nice buy area. That's telling you that the stock's picking up and has some momentum to go higher. So like I said, this was a range-bound trade. After earnings, it turned into a hook pattern. We were able to quickly pick that up, trade that hook pattern, and make a nice profit on that of around 107%. And then we were trading this. And if you go back in my Facebook group, I even made some charts back during this time frame saying, guys, bookings, a great trade right now. Obviously, bookings price line here. I just changed its name, but price line, booking, whatever you want to call it, it was a great trade. We traded this fairly well for the past several months. And like I said, I even posted it in the main Facebook group. You could go back there, search it, and see what I was talking about during that time frame. So those are the types of targets you're looking for with, range-bound, channel-bound type of patterns, breakout momentum type of patterns, and hook patterns. So that was it. There's one more here on Goldman Sachs. And also, we had a losing trade on Goldman Sachs that I want to go over because people say I never go over losing trades. That's not true. I don't like to harp on them because obviously they sting when you have a losing trade, but let's go over it. So first off, I have this as another example of a range-bound, channel-bound pattern. So let's take a look. Here's Goldman Sachs. So as you can see here, it just started this nice channel here. We have 2 points of contact at the top here for resistance. We have 2 points of contact for the support. So Goldman, the red line here you see, that's the 50-day SMA. It got down to that, pulled up a little bit from that 50-day, which was acting as support, which is great. If Goldman does drop a little bit more, I really don't see it dropping more than out of this band here, the lower channel here of the yellow line. So I don't see it going much further below 230, I'd say. But if it does get down to 230, that would be a nice buy signal, and then you could sell it halfway between the channels. So if you're getting in at 230 and the upper channel here is at 250, you could sell it right around 240. That could be your target profit area. This target profit area was not for this this channel bound trade. This was for kind of like a hook pattern. Not really a hook, but it got down. If I extended this out, you would see that it got down to major support, and a lot of the articles were saying about the banks going higher. It was a great trade. The problem that we had was we needed a little bit more time until expiration. So if you're not in Goldman and you're looking for a good trade setup, Goldman is looking to be a good setup. Either Monday or sometime this week, you should get a signal on Goldman. And whether it starts to form a green candle and go higher here, that's your buy signal. Or if it continues to drop, the first day you see that green candle and a reversal, that would be your entry as well. And then, like I said, your target or your target profit area is going to be halfway up from the from the two channels here, the two lines. So from resistance to support, if that's, let's say that's 20 points, then 10-point higher from the bottom of the channel, that's your target profit area. So like I said, our Goldman trade, it was a great trade. It just needed more time. And, you know, that, and when you're trading, guys, that's important. It's important to understand why, if you have some losing trades recently, why are your trades losing? Are they just bad picks, or are they bad, you know, are they bad time frames? You know, is it a good trade, but you just needed more time? Or did you pick a stock that wasn't that great of a stock and it just kept going lower, or did the reversal or opposite of what you thought? And that's really what you have to focus on your losing trades. Was it a bad stock pick that you picked, or was it you know, a faulty expiration or strike price that you picked and you just needed that little bit more of time? Or was it a different, or was it the wrong strategy or technique that you used? For example, did you buy a call that was too expensive that the stock didn't make a significant move to cover the cost of that premium? Or was it just a trade that, you know, it was too expensive, and even though the stock moved, it wasn't enough for you to make a profit? So you have to decipher each of your losing trades. See, was it a bad stock pick? Was it you know, more timing that you needed? See what it was that made that trade a losing trade. And like I said, with the Goldman Sachs, it was just that we needed more time. As you see here, you have waves, you know, and that's important as well. You have to understand stocks, when they're moving, they have waves. You know, here's a wave higher, and then here's the pullback. Here's the second wave higher. Here's the pullback. Now our third wave is going to get up here, and then we're going to have another pullback. So you have to understand that, you know, some of these stocks, especially the types of patterns that I went over today, specifically the breakout momentum and the range-bound, channel-bound trades, they trade in waves. You know, especially when you have those channels, you know, they're hitting up to that resistance, they're pulling back, and then they're having that next wave higher, then the pullback, then the next wave higher, the pullback, then the next wave higher. So you have to understand that, and you have to give yourself enough time for your trades to work out. So like I said, those are the three types of chart patterns that you could trade for significant returns. Hook patterns, breakout momentum, and range-bound, channel-bound trades. Those are the three types of patterns you want to look at for success and for large profits. All right, so quickly here, you know, we have a promo code for those of you that are new. Santarelli Exchange, you could use promo code TRADE for only $49.99 for your first month, or you could use promo code QUARTERLY for quarterly billing of $399.99 every 3 months. And here's our web link. You get trade alerts sent via email and text, as well as posted on the site's trade feed and portfolio. You get trade updates, market news, upgrades, downgrades, initiations, unusual option activity emailed to you. You also have a great live trade room full of a great community of traders and members. So if you're new to the Facebook group and you'd like to join, feel free to use one of these promo codes. And if you haven't been a member for at least 3 months, you can use one of those promo codes. But if you do, you know, if you're one of those people that are using a promo code, quitting, and then signing up the next day, you will be banned and put on the blacklist. So now let's do some Q&A and see if you guys have any questions, anything you'd like to go over. I thought this was going to be a short video, but we're already an hour and 20 minutes in. So if you guys have any questions, please type it in the chat, and we could go over it now. Or you guys could, let me see, I could put on your mics if you guys want to talk. What are you thinking when deciding between straight calls versus a spread? Doc, that's going to be another video. We could do that video right now, actually, if you'd like. It's just that's going to be another, larger topic. You know what? Let's end this video and we'll get right into another one. That sounds great. All right, guys. So that's it. If you guys have any questions, you could feel free to message me, email me, call me, email me. Like I said, you could contact us on our website, thesantarelliexchange.com, and feel free to use one of the promo codes and come join us. We have a site of over 1,200 members, and we have a great community of traders, and we're really going to help you along the way and teach you what you need to learn to become a great trader. So, like I said, we also have a live trade room. This is the trade room here. Members are talking throughout the day. We're sharing charts, trades, all that type of stuff. So feel free to join us and join us in the live trade room Monday morning. Alrighty, guys, take care. Have a great night. God bless, and I will see you tomorrow.